And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's the Hump Day edition of The Real Investment Show as we get this Wednesday underway. Of course, yesterday, Super Tuesday. So we now have, pretty much knowing what's going to be the next presidential election lockup at this moment. Anyway, certainly looks like it is going to be a Trump-Biden election in November. So again, this is going to put a whole lot of potential risk to markets as we get into summer ahead of that actual election itself. So again, as we've talked about before, and I've got an article coming out on Friday talking about presidential election cycles, what happens in presidential election years normally, going back, looking at statistics of the market. And again, as we talked about before, the risk to the markets is a bit of a correction sometime this summer around, again, a 5 to 10% correction completely within the realm of possibility, very normal for any given year. But that's kind of the thing to be looking at. And so that we'll have that article out on Friday. We'll talk about that next week. So outside of that, yesterday, good bit of economic data out. None of it really great. Durable goods orders weaker than expected. And again, this continues to be really kind of the juxtaposition, I guess, of the markets. Markets are doing fantastic, acting like the economy's just firing off on all cylinders. Yet you take a look at a lot of this economic data showing signs of weakness. ISM services, 80% of the economy showed weakness yesterday. So again, we have this real dichotomy going between the markets and what the markets are thinking right now. A lot of exuberance in the markets. Investors are extremely optimistic about the markets and the outcome of the markets over the next several months. But yet the economic data certainly doesn't support that. Now, today we've got more Fed speakers out today. We had Fed speakers out yesterday, more out today. Of course, now they're about to go into blackout because we've got the Fed meeting coming up in the middle of the month. So they're about to go into their blackout period where we won't hear from them for the couple of weeks heading into the actual meeting itself. But we've got some Fed speakers out today, Neil Kashkari, others. So again, be kind of listening to what they say as well about their expectations for rate cuts. Because again, this rally is all on expectations of rate cuts, more liquidity, more accommodation. Yet this economic data certainly doesn't suggest maybe that's going to be the case just yet. Again, as we talked about just yesterday, inflation remains very sticky here, which certainly suggests that the Fed's likely not going to be cutting rates anytime soon. Maybe not even this year. And that's something that probably the market hasn't quite factored in yet. Now, interestingly enough, though, we've also been talking about for a long time inverted yield curves, of course, which have a perfect track record for predicting recessions. Certainly doesn't seem like we have a recession, near term, certainly not in the cards, right? But the inverted yield curve has now been negative for 408 days. I believe that's the correct number. The longest stretch prior to this was 1980, where it went 413 days. So we now have a yield curve inversion that is probably going to, it's going to set a record for being the longest stretch of a yield curve inversion in history. And the interesting thing is that we don't have a recession yet. We've always had a recession. Every time previously we've had a yield curve inversion. When that yield curve uninverted, you ultimately had a recession in the economy. Yet, again, when you take a look at a lot of the data, excuse me, certainly does not seem to be the case right now. And again, we go back to the Fed, we go back to, one of the interesting aspects of this market, as we've talked about, is that this market is just extremely bullish and acting. You look at what meme stocks are doing, Bitcoin, etc., all of these kind of, risk on assets. They're acting like we've got stimulus, QE, and zero interest rates, and yet we don't have any of that right now. So it's very interesting what's happening in the market, the amount of speculation that's going on. Yet underneath the surface, there's a lot of things that suggest there's certainly risk to this outcome. Okay, that brings us up to what to expect today. So let's talk about before the bell. Here's what you need to know before the bell this morning. The markets, again, like clockwork, and this has been a really amazing, kind of trend we've had the markets really over the last several months, but actually going back to November, and again, we talked about this yesterday, is that this market just continues to trade in this very tight range. We got to the top of that range on Monday, Tuesday, sold off to it, touched the 20-day moving average yesterday, and bounced off of it right at the close. This market this morning looking to open higher. And again, yesterday we had this sell-off in tech stocks, cross the board, Apple, Microsoft, Google, all down. Bitcoin had a big drawdown yesterday. So again, very interesting. Comes right down to this support line, and all the computer algorithms are going to kick in this morning and start to buy that 20-day moving average. So the markets are going to open up this morning. But again, it's just been a really phenomenal stretch, as we talked about yesterday. When you go back in time, we don't see periods like this previously, where you have such a low volatility move and markets just kind of stay in this more kind of overbought territory for an extended period. We just haven't seen one like this without having a correction of some sort kind of along the way. But again, this is what the market's doing right now. And again, there's no reason to worry until we kind of violate that trend line. And we will. At some point, we're going to take out this trend line support and the market's going to go lower. The issue, though, is that we're continuing to build that bigger and bigger deviation from the 200-day moving average, as we've talked about for the last several days. So again, the risk is certainly there for that correction to occur. And again, this kind of was an interesting day yesterday in particular, because volatility, again, we had a fairly big sell-off in the markets. Markets were sold, the S&P was down about 1% yesterday, and volatility actually declined yesterday. So, so this has been a really interesting move in the markets, because again, we've had this slow grind higher and absolutely just a very low grind in the underlying volatility index itself. It's just been very low. You have very little small spikes in volatility from one day. You have a sharp down move in the market, maybe volatility spikes up a little bit and then goes right back down. So again, just as soon as the market does sell off a bit, people are coming back in to short volatility, betting on the market continuing to move higher. But again, we have volatility running at extremely low levels. In fact, if you go back over time, we've got volatility trading at some of the lowest levels that we've seen since really prior to the 2020 kind of pandemic shutdown. Again, volatility just continues to kind of trail off lower here, as really the expectation of a crash or a correction simply doesn't exist. The people are not betting really on taking out any type of protection against their portfolio for a potential reversion in the market. So right now you can hedge your portfolio extremely cheaply right now. And portfolio insurance is extremely cheap right now because nobody wants it. So nobody's willing to take out, to spend money to hedge, because markets are only trending higher here, particularly across multiple asset classes. And again, one of the most speculative asset classes we've got right now, of course, is Bitcoin, which, yesterday had a very, very sharp decline. And this morning, had a big decline yesterday, took out the previous day's gains. This morning, opening up again, basically recovering the vast majority of that loss yesterday. So again, just a lot of volatility in the markets, but markets really not going anywhere and staying in this really kind of defined range. So again, nothing to worry about at the moment, but watch that 20-day moving average. You break that, I think you're going to get a much bigger selling program that kicks in. That's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff. We got to talk about, is it a bubble or is it a market top? That's what Jim Cramer says. We'll talk about that next. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So is it a bubble or is it a market top? That's the question, right? So we were just talking about a minute ago, this market's very extended here, very optimistic. And it was interesting because Jim Cramer, of course, came out just yesterday talking about, well, this looks more like a market top than it does a bubble. I'm not sure that matters to a lot of investors, but, it was kind of an interesting, topic. Because again, there is a lot of conversation right now about this potentially being like the dot-com bubble. Again, NVIDIA versus Cisco going back to 1998, 1999, lots of similarities. At that point in time, as an example, Cisco owned about 50% of the market share of routers for the markets. Now, remember, this is the internet.com era. So we're all going to have, in order to compete, we're all going to have internet. We're all going to have network servers. We're all going to have websites. And Cisco owned about 50% of that router market, and they had about a 50% margin. The expectation was at that point is that Cisco would continue to maintain that in the future. Of course, that didn't happen because success in that market brought in other competitors. Today, as an example, NVIDIA has a 75% market share with a 75% profit margin, and everybody's expecting them to maintain that into the future. So again, there's a lot of bubble comparisons because we're seeing some of the same type of projections being put out there in the markets relative to, certain stocks, certain companies. Another one is a small cap company called, SCMI, which is now joining the S&P 500. So in a rare event, I've gone back in history and I can't really find another occasion of this where you have a small cap 600 company jump immediately to the S&P 500. Normally they go 600 to 400 to 500. So again, we're seeing this one company that's had just this massive surge in price over the course of just the last few months, has become a large cap stock because of that move, is now joining the S&P 500, and this is a company that makes servers. There's a lot of companies that make servers. Dell makes servers. So again, there's a lot of expectation that these companies are going to be able to maintain this growth rate well into the future. So that brings up this concern of a repeat of the bubble that we saw previously. And again, there's some valid comparisons to that. But the question is this, are we in a bubble, or is the market just building something that's probably more akin to a market top where you have a 10% correction, something like that? So, Danny, what do you think?
Man, that's $1 million question, Lance. I mean, I think there's so many variables that are occurring right now. I think that, you hit what you're discussing and talking about, that, we see this bubble kind of pattern in a lot of ways, so many things that have gone just up exponentially, but yet most of the market's not participating. So I think that's a big part. I mean, we've seen a little bit more sector rotation, I think, this week, seeing money, profits being taken out of some of those high flyers, moved into some of those other areas that maybe hold a little bit more value in general. But this is where maybe it is a top because nobody else is participating. Right?
Exactly, yeah.
Whereas, usually that big bubble would burst and you'd see everything fall. This may not be the case. Market participation was so poor last year, and here we are once again with the same problem. So maybe that is what's going to happen. Seeing companies go from, small, mid to large just on a function.
Well, no, it skipped mid. It went small to large.
Small to large, yeah.
Yeah.
But on a function of just flows, it's crazy to watch.
Yeah, it is. And again, I'm wondering, this is one of those things, look, indexes are just like humans, right? They want to create performance. They've got to have performance. And so it's going to be very interesting to watch, particularly in this one case where, this one stock has gone up 1,000% over the course of the last, 6 months. And now S&P has decided, I'm going to stick that into the S&P 500 index now. And it'll be interesting to see that if in a year or two it goes back to the small cap index because of the reversal. Yeah, and they're going to have to take it out because it's no longer large cap. But again, we'll see, right? Anything's certainly possible. But it was interesting. So, speaking specifically at Jim Cramer was on Tuesdays. It was on CNBC yesterday, and he said toppy action may not be great. He said, but it's much less devastating than a burst bubble. The latter occurs when stocks climb to new highs, then fall back. When the former refers to just stock prices exceed the fundamental value and then have a correction back to that. So, it's kind of you're kind of picking definitions a bit, but obviously if you get a bubble that burst, you're going to have a massive a mean reverting event in terms of not just stock prices but valuations. That's going to normally align with a much weaker economic environment. You need a recession for that to occur as well. So again, you think about what happened in the dot-com bust. We had a recession that tagged along with that, obviously, because you're now reducing the value of the market. And as you reduce the value of the market, that crimps consumer confidence. They stop spending, you get a recession. So again, right now, it certainly doesn't seem like that we have the recessionary ingredients at the moment. Doesn't mean they can't show up because the economy is certainly weak enough for that to occur. But we don't seem to have any real indication at this moment in terms of labor or anything else that a recession is imminent. So again, probably Jim's right in this point is that, a correction is very likely this year. Again, we've been talking about this ad nauseum for the last couple of weeks, but it's just a function that we're going to have a 10% correction at some point this year, and it could even be larger heading into the election. We'll see what happens, but that's going to be, probably the outcome to be looking at. So, in other words, maybe don't worry as much about this being a bubble. Focus on a correction because you'll have a correction before the bubble burst anyway. And so you'll have a bit of a decline in the market. The market will rally back. And then if there is going to be a bust at some point, you'll have plenty of time to see that coming. You're not going to wake up one morning and the market's down 50% overnight. That's not going to occur. You may wake up one morning and the market's down 5%, and that'll be your indication that the bubble has just burst. Then you sell, right? But you're down 5%, and you're going to avoid the next 45 on the way down. But that's the thing, and as always the case when managing money, it's just always important to let the markets tell you what to do. Don't try to predict what markets are going to do. That's where you wind up on the wrong side of the trade. And people continuously do this, but just wait for the markets to respond. Yeah, you're going to lose a little bit when the market initially breaks. That's okay. You're going to avoid a lot of the downside. It's just like trying to buy bottoms. Don't try to pick the bottom because that's generally where you're going to lose more money. Wait for the market to bottom, turn up, and then you buy it, and you've got plenty of upside. So again, it's just you don't have to nail these things precisely. This isn't a competition. It's not a game. It's just let the market dictate what you do with your portfolio rather than trying to guess at it, because we're terrible guessers as humans.
Well, I think that's what's made this market so difficult. It's been a challenge because you have had strictly those specific companies that have done so well.
Right.
And so you can pick on based on fundamentals. You can look at all the data and say, wow, this is a really good company. It's priced attractively, yet that doesn't matter. And I think to your point, we have to remember, how often do we see a 5% drawdown? 2-3 times a year,
right.
A 10% correction every other year. So these things are not uncommon. And typically when we do see highs, they come kind of in bunches, right? We get a high, then we kind of drop a little bit. We get another high, we drop a little bit. It's not that we get a high and then we're going to just wait a while and then go get another one and another one. They come kind of all in a specific period of time. And so it would not be unlikely to see, the opposite occur. Now, with Jim saying though that, talking about this, it makes me think that the opposite will happen.
No, it's true because Jim's generally wrong. So, which means this bull market may go on for quite a bit
Forever.
longer. This may be it. This is the inverted bubble. It just keeps going up.
But then you have the opposite that everybody thinks there's nobody short. Everybody's going long right now. And so you're like, okay, well, that doesn't work out either.
But, look, even a blind squirrel finds a nut every now and then. But, it's one of those things where, this really isn't a hard top to call.
Yeah. Because
look at what's happening with Bitcoin. And look, again, as we talked about yesterday, I have nothing against Bitcoin, but take a look at what Bitcoin's doing. Gold has become a speculative asset over the last 6 years. It has a very high correlation now with stocks. So when stocks are going up, people are buying gold as well. So gold has become, and I'm writing an article on this for Tuesday, but gold, Bitcoin, these are now becoming speculative assets. Take a look at, again, moves like Supermicro Computer, NVIDIA, others. There's just no compunction about hedging risk. And so again, yes, we've been talking about a correction now coming for weeks. And this is very similar to what we saw in June and July of last year. If you remember on the show, June, July of last year, we were talking about for weeks we were going to get a 10% correction, and it just didn't occur. And then it happened in July, August, September. So, it's going to happen. And again, this is why it's so difficult. I mean, we have these conversations in our portfolio management meetings in the mornings, which is we need to sell off NVIDIA and AMD and take profits. So, those positions are up 90, 100% since we bought them. So we need to reduce those, but we can't right now because they're still going up every day. They'll be up again today.
Well, you can. I mean, but you have that fear of missing out of what happened. I mean, we reduced
it's a performance.
A year ago with 100% profit, give or take, and what? NVIDIA was 31 times price to sales, and now it's 50.
Yeah,
I mean, it's nuts.
Yeah, this is the second time we traded it for 100% gain, and it's just a issue of market. So, and trying to balance performance and returns with some risk management. It's just very difficult. And this is just where we are. So we kind of got to ride the wave for the moment until it turns, and then quickly remove ourselves out of the way. All right. So we'll come back. Interesting. The federal government is now going to match your 401k plan. Talk about that with Danny after the break. Don't go away.
We'll see if they will.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I learned a very valuable lesson yesterday, Brent. You know, my wife had a really hard day at work, and she came home, and she was a little bit stressed out. I said, well, honey, I'll take you to go get a scoop of ice cream. She said, no, I can't. I'm too fat. That's where I made my critical mistake.
The Real Investment Show podcast.
I said, okay.
Same show, your schedule.
Then I realized at that moment that I'd made this crucial mistake, which was I should have said, no, you need to get 2 scoops because you're too skinny.
At realinvestmentadvice.com.
You need some ice cream. Go eat a cheeseburger.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So again, you know, it's interesting because, you know, we've talked about before about 401k plans, and, you know, there's a real lack of participation in 401k plans around the country, and obvious reasons. You know, people just want to try to make ends meet at home, and they just feel like they can't afford to have anything go out of their paycheck to go in their 401k plan, which is a terrible mistake because, you know, even if you just contribute enough to meet the match, you're not going to miss it coming out of your paycheck because, again, the dollars in your paycheck are all taxed. So the money you take out that goes in pre-tax into your 401k plan reduces the amount of money that you're going to pay in taxes on the balance. So you can actually contribute money to 401k plan and actually wind up bringing home about the same amount of money as you were before because you're reducing the taxable issue. But again, just when you take a look at the participation of all the companies that offer 401k plans, only about 50% of employees actually participate in the plan. Of those 50%, only about 25% actually contribute on their own to the plan. So in a lot of words, you know, a lot of companies will just give you some money just to participate, but they don't add any additional to it. So again, when you just take a look at the participation rates of 401k plans, it's very, very poor. And again, we know this in the numbers also. You know, Fidelity and these other companies come out every year with 401k plan updates. And I always love the analysis from Fidelity, because if Fidelity comes out every year, it's like, we have more 401k millionaires than ever, right? 350,000 people are now millionaires in their 401k plans. Sounds fantastic. Until you do some analysis, which is always the case. And what you find out is that the 300,000 people that are 401k millionaires makes up exactly 1% of their 401k plans. In other words, it's the top 1% of income earners, and just goes along with the other statistics we know in the market. When you actually start looking at average and median balances of 401k plans, it's much more depressing. On average and medians, they're between $55,000 and $65,000, and that's about 1 year's income for the vast majority of Americans, right? So it's just not what it is. So, you know, the government's been cut, and this started under the Obama administration. The Obama administration floated this idea of a federal IRA, and they were going to put this IRA out there to help, you know, support people's retirements, and you put money into it, the government would match you, and it went nowhere. It died quickly. And so now we've gone through these kind of maturations of trying to figure out how to help people, and we consistently kind of send people more money, and we send them checks, and that doesn't work. It doesn't get people out of poverty. A very interesting, you know, analysis there. When Biden took office, and we did the $1.7 trillion worth of funding, we wrote an article about a comment he made, which is that the analysis at the time was this was going to lift a vast portion of people out of poverty. And we said, yes, that will be the case for 1 year, which was exactly what happened. We now have more people in poverty than we did before because of inflation, which is the byproduct of sending checks to households. So again, we try to, these things are always done with the best of intentions, but they don't really work out that well. So here we have a new one. Oh, by the way, California now wanting to give 20% down payments for homes and no monthly payment. So if you live in California,
wait a second.
If you live in California, you can now get a 20% down payment on your house and no payment on that money. And when you sell your house, the state gets paid back. Oh, by the way, you have to be illegal to get this program. But as long as you're an illegal immigrant, you can get a 20% payment-free down payment for a house.
How many people are going to be denouncing their citizenship, sneaking over? Hey,
I'm just saying. So now, if you don't think you have a housing price problem in California now,
yeah,
wait till this kicks in. If it gets passed and all this, but this is the idea. If that kicks in, you've got a whole rash of new people buying houses that they couldn't afford to buy in the first place.
I don't want to get real political here, but why do we keep on trying to get people to run the country who are in California?
I don't know.
I mean, clearly we're making really good decisions.
I don't know.
But getting back on the 401k, because...
But yeah, this was the point. So, but these all have bad... My point is when you do this stuff always turns out to have bad consequences. And again, this is another idea where government's going to try to help out and solve retirement. I'm just wondering what the bad consequence of this is going to be, but go for it, Dan.
Well, I don't know how much the consequence is going to be, but, you know, going back to those numbers, so How America Saves, a study by Vanguard in 2023 showed that those balances that you mentioned, Lance, they came down by 20%. We saw Fidelity, you know, in 2022, their average account declined by 24%. So a lot of disruption in people's savings for retirement. But, you know, those numbers, when you mentioned like $50,000 in a retirement. Now, that's across all demographics, all age groups.
Right.
And so more commonly, most people think about, well, what about somebody who's going to retire? Well, that's like $237,000 or $232,000. But the median, it's like you mentioned, it's $70,000.
Yeah.
I mean, hardly anything to live on.
Right, and that's the real, and this is the interesting thing about this plan, right? So anyway, to get to the story here.
Well, that's why they're doing this,
right? So federal matches are coming. This could boost retirement. Nearly 22. And I'm just read you the quick headline, and I'm going to tell you what the flaw in this all is. Nearly 22 million Americans could qualify for new government matching contributions designed to boost retirement savings when the program takes effect in 2027. According to researchers, lower income workers who contribute to a workplace retirement plan would be eligible for a match of up to 50 cents per dollar, up to $2,000 annually for a maximum benefit of $1,000. Let me tell you the problem here. We just went through the numbers. 50% of people don't even contribute to the 401k plan, right? So those are your low income workers that are needing every dollar to come home. So you may have this plan available, but it still may not help them because they're not contributing to 401k plans.
Well, not only that. So number one, they're not contributing because the numbers, the income levels you have to be under to meet these requirements, there's no way you're putting money aside.
Exactly. That's my point.
People just aren't doing it. People are struggling enough with inflation, with higher interest rates, all the things that are occurring, that people make much, much more are struggling to do so. So for you to actually qualify for this program, now they actually show that there's 83 million taxpayers that qualify, but only 22 million of those 83 million have wage income. So what are the rest of those, say, 60 million people doing?
And there's another problem with that too, right? So out of all the companies in the country, right? So if you take a look at companies business owners across the country, 50% of them have fewer than 10 employees. Now, Danny, how many businesses that have 10 employees or less can do 401k plans?
Well, but you can also go and contribute to an IRA. So that's a caveat. You can go and set up an IRA and contribute to it. But then my thought would be is how many of these people are going to find somebody to help file their taxes, and therefore let them know about this credit that they can potentially get? Because do you think that the IRS can say, "Oh, look, you made a contribution to your IRA. Congrats." So it's only 50% of $2,000 up to, right? So you get $1,000 as a maximum benefit they'll give you. But your income levels have to be so small. So if you think about this matching credit and how to get it, you have to be, for single, you have to be less than $20,500.
Right.
Well underneath the poverty line. For a family, $41,000.
Yep. Still underneath the poverty line.
Yeah. So you're going to put that money in my 401k or my IRA. What am I going to do with it when I don't have any money anyways?
Right. No, and look,
I'm going to pull it out and spend it, right?
Right. No, and this is, look, I love the idea of the plan. You and I have been behind this for a long time, is that I don't understand why we have caps on Roth IRAs. I don't understand why we have caps on IRA plans.
Yeah.
Contribute as much as you want to. Look, we have a Social Security problem, right? We all realize this. This is not rocket science, and we need to help people save for retirement. So stop putting caps on contributions. If I want to put 100% of my paycheck into my 401k plan, great, let me, right? If I want to put 100% of my paycheck in a Roth IRA, you get your taxes now. For some reason, I don't need any money to live on. Maybe my wife is a retired millionaire and I'm just married to her, right? I'm a stay-at-home husband, whatever. But if I want to, why are you capping me on how much I put into my retirement plan? That just eases the burden on Social Security at some point down the road. I'm
not sure they want to ease the burden. I mean, they've had plenty of opportunity to fix it. That's the problem, right? And so, but I
still understand why there's a cap. Let me save as much as I want. Why do you care if I save money?
This is window dressing is all this is. This looks good on paper. It looks good in the headlines. And say, look, we're doing that to help wealth inequality. This doesn't do much.
It doesn't do anything.
Because out of that 23 million, how many are going to actually take advantage of it? Very, very few.
This is the same thing with the IRA that Obama did back when he was his first term in office. He did that IRA, the government IRA, and it went nowhere. Why? Because nobody contributed to it.
Well, it's a uniform savings account is what Kevin Brady campaigned on. They've talked about for years. They actually tried to get that passed where you could go out and say, put $8,000 a year into this savings account that would grow tax-free.
It was all in U.S. Treasuries.
Well, no, you had some flexibility what you could do, but none of it made sense because they would never go for it, which I don't understand why they want to disincentivize people to save.
That's my point, right? If you want to get people out of poverty, help them save money. Stop putting limits on it. Let them save as much as they want. Yeah. You can look. I can make as much. I can save taxes by making charitable contributions to any amount I want. Right? There's no limit to charitable contributions.
Yeah.
Why can't I do the same thing? If they're going to give me a tax credit for charitable contribution, which I'm all for, give me a tax.
There are limits up to
I know,
income,
but there's a lot. I mean, you can do a lot in charity. But I'm saying, give me a bigger runway for saving for my own retirement.
I agree.
Yeah. Anyway, all right,
Lance.
I'm done ranting.
Hey, man, election period.
You could not pay me enough.
Oh, I'm sure somebody could. I mean, these guys seem to be making pretty good money.
Could not pay me enough. All right, quick break. We'll come back. If the economy's doing so well, why do people feel so badly? Danny's got the answer.
That I do not.
Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, if the economy is doing so well, why do people feel so badly? And it is kind of an interesting question because, again, as we are getting ready to, gear up for the presidential election, we now, after yesterday, Super Tuesday, we now know, at this point anyway, the most obvious candidates are going to be President Trump for the Republicans. Donald Trump for the Republicans, President Biden for the Democrats in the November matchup. So now, again, things can happen between now and then, but that's what seems to be the case at the moment. So it is interesting, though, when you take a look at presidential approval ratings for the economy are at some of the lowest levels for any president going into an election. Yet, we take a look at the economic data. You've got near record low unemployment. You've got near record low jobless claims. You've got inflation that's coming down. The economy's clicking off at 2.5% or 3% right now in terms of economic growth. Yet, people's view on the economy is pretty dire. And so there's this real break between the economic data, what the economic data says, and don't forget the stock market, because the stock market's ripping off to the moon. So again, if the economy was not doing well, the stock market should not be doing well, right? So that seems to really fly in the face of this attitude of the average American when you ask them, how do you feel the economy's doing? And it's also very interesting, the difference between when you ask them, okay, how do you feel about the economy? And you take a look at consumer confidence. Consumer confidence is rising, yet they feel very poorly about the economy. And again, consumer confidence is driven by the stock market. So again, not surprising there. But yet, we're not seeing that in a change of attitudes. And so this is going to be a really interesting situation, over the next few months. Does the economic data eventually play catch up with consumer attitudes, or do consumer attitudes eventually start to catch up with the economic data? But Danny, what do you think? I mean, it's kind of an interesting
What is? I think
issue.
There's so many dynamics that are occurring right now. And you mentioned, the presidential election, getting a little bit more clarity surrounding that. But, even then, I'm not sure everybody's convinced that either one of these guys will make it to the finish line potentially. I mean, we've talked about that. Who knows what that actually looks like? But how many times have you actually had an ex-president run against a sitting president? I mean, that's
4.
It's very uncommon. And
I don't know what the outcomes of that are, but
I don't either. Very polarizing too, and especially in this day and age. What I find interesting is that we've seen like you mentioned, job numbers are good. Most of the economic data, there's nothing that suggests that we're just we're veering right into a recession. Now we still have those pretty tried and true warning signs still flashing. You mentioned that in your first segment, the yield curve being inverted. We've got the economic index, the leading economic index, still down. Almost 2 years running, consecutive months. I mean,
it will actually tie. The leading economic index will tie the record for the longest period of being negative this month.
Wow. So which are historically very good indicators. Now, short term, not so much, but long term, typically, yes. But, and I don't know where that's people seeing that. I mean, we get some numbers that are pretty good, but I think where people see it, Lanso, is, I mean, you look at the other side, and we have this conversation frequently with clients. We almost have the tale of two economies in a lot of ways, right?
Right.
You've got a lot of money that's still sloshing around from all the stimulus packages, all that they're trying to do to prop this year up. And nothing as of right now is extremely bad. But if you look at the consumer, record high levels of debt. You look at, we know going to the grocery store, it's frustrating. You go out to eat, it's frustrating. Things are expensive. So I think that's probably where a lot of maybe this, the negativity around it comes from.
Yeah.
Because everybody's just frustrated.
Yeah, I was listening to a guy on the radio the other day. I was driving around somewhere, and they were interviewing this guy, and he's like, he's some economist or whatever it was, and he's like, so I measured what I spent at the store last month, and I spent $1,500 on groceries at the store last month, and then he goes, and we almost eat out every day. And we spent $1,100 eating out on top of the $1,500 in groceries. So I was doing quick math in my head. So, that's $2,600 a month you're spending on food. And I'm sure there's a lot of people driving around listening to this guy right now going, you're spending $2,600 a month on food. I'm not even bringing home $2,600 a month, right? And I think that's where the frustration is, because, again, when we just saw the data recently that food in total, now this is food at store, food eating out, et cetera, food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yeah.
And we rarely eat out. I mean, we eat out very seldom. And that is our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. Better. I agree. We're running Hunger Games at our house.
Are you?
So,
Good for you.
I
may have to implement that this week.
So, if you can make it to the table without getting killed, you get to eat. It's
kids
a game of survival.
Kids are off on spring break, so maybe we need to institute some type of games to, I think we should have to put a lock on the pantry.
Yeah, it'll be interesting to watch. But no, it is. But, for the average American, it is tough. I mean, the cost of food and eggs, and, it was interesting because, time. Sometimes I just kind of want to just go, oh my gosh, I can't believe he did that. President Biden was out yesterday quoting the Cookie Monster. That Cookie Monster from Sesame Street was upset because he tweeted out that his cookies were too small and they were costing.
Hey, I understand.
Right, but it's shrinkflation, right? Yeah. And so President Biden was like, that's probably not ideal to quote that, but yeah, I mean, if you're going to channel somebody, probably don't channel Cookie Monster.
So President Biden, was he upset with Nabisco or the cookie makers? Or?
No, the Cookie Monster's upset.
No, but you said President Biden.
President Biden has been.
So where was he going?
Well, he's been lately, really going after this idea that corporations are gouging Americans, and corporations are just being greedy and not cutting prices to help the average American out. That's not their job.
Well, they're a for-profit business, so that's where I have a problem, right? Because we don't need government intervention on something like this. Typically, you would say, okay, let the market dictate. If you know what, you're tired of this and you don't like these Chips Ahoy, go get some Oreos or go get something different, or don't get them at all because you can't afford them.
Well, there's actually a boycott going on social media.
Okay.
So for the months of March and April and May, you're not to buy any Kellogg's products. So what consumers are trying to do is they're trying to organize a ban against Kellogg's because Kellogg prices are just too high, right? I mean, the cost of buying Kellogg's products, cereal, et cetera, is just very high. So what consumers are trying to do is organize on social media to start kind of fighting back by saying, look, for the next couple of months, don't buy any Kellogg's products. But it's interesting, because it is interesting that consumers actually have the power. You could fix, in a way, you could fix these problems if you stop buying the products. As long as the company can sell you the product, as long as you're willing to buy the product, they're going to keep selling it to you. And they're going, well, I sold this product last month for this price, and they kept buying it, so I'm going to keep selling it to you at this price. And they're going to keep selling it to you at that price until you stop buying it. And then demand is what drives prices. If there is no demand, the company will lower the price in order to get demand back for their product. So consumers do have the choice, but it's difficult because you say, look, I've got to feed my family. And yeah, I can stop buying Kellogg's products. So I'm not going to buy cornflakes. I'm going to go buy, I can't buy Raisin Bran. That's Kellogg's. What cereal is not made by Kellogg's?
They make a lot, but I was just thinking
Wheaties.
I couldn't hurt them.
Yeah.
I mean, we don't eat any of these things. Frosted Flakes, Fruit Loops, Mini Wheels, Mini Wheat. Excuse me. See, that tells you how much of this stuff we buy. Rice Krispies.
But General Mills is just as expensive, right?
They're all expensive.
They're all expensive. So you've got to. But and I did see, for instance, Pop-Tarts are very expensive now. And so I'm seeing a lot more people coming out going, hey, here's the recipe to make your own Pop-Tarts at home, which is, by the way, very, very easy.
Well, probably much healthier for you anyways.
Sure, it is.
I mean, most of this stuff is junk. Let's be honest.
It is. But the point is that, this is going to be interesting to see if people can start to push back enough that it actually causes corporations to rethink pricing. I don't know. We'll see. But this is the biggest problem. If you really get down into the crux of what the problem is, it's food, it's utilities, and it's housing, right?
Yeah.
That's the biggest makeup of people's discretionary income of where it goes, and all those are expensive.
Who did the government just get after for having a monopoly?
Or trying?
Yeah. Who was that recently?
I don't know.
I don't know. There was an acquisition going down. Anyways, I was just thinking about that. Yeah. Holy smokes. General Mills, they own everything.
Yeah, they do. And that's what I'm saying. You don't have a lot of choices. Great. I'm not going to buy a Kellogg's product. I'm going to buy a General Mills product. General Mills makes everything else.
I mean, but not only that, but every other brand that you think may not be, you think it's an independent brand, they've scooped up.
Yeah. No, it's a huge conglomerate. So, but that's it. I mean, and so that's why people, but look, bottom line, that's why people feel so bad about the economy. It's like the economic data is fine. They just can't make ends meet at home. That's the problem.
Well, but that's what scares me, Lance, is like how long can that actually occur? Is that, we can't make ends meet. We see these record levels of debt. At what point does that matter?
It matters because right now earnings estimates are at records and earnings expectations and corporate profit margins are at records and expected to increase over the next 3 years.
Everybody's credit card balances are going up.
Right. Well,
your limits are higher.
At some point, it matters to earnings and profits.
Well, when do they not let those limits continue to climb, right?
That's
and
correct.
That's going to be an issue.
And then that hits the market. And then you get a decline in confidence, and then everything resets. So on that good note, we'll end the show for the day. Danny, thank you so much. Be sure to buy the website, realinvestmentadvice.com. Mike Leibowitz's latest article out on liquidity on the website now. We'll talk about that tomorrow with him on the show. Of course, if you have any questions or comments, let us know. Have a great day.